Oh my goodness, that last week was a roller coaster of bad news, not so good of news, and then oddly some good news. Recent inflation reports, specifically CPI and PPI, dropped, and at no surprise, and despite President Trump's promise otherwise, inflation is still very much present. Stick around, I'll fill you in on the exact details and how it impacts mortgages this week. An impending mortgage desert could be the case in as early as the next 10 to 20 years. Sounds like a scene out of Mad Max, but for real, Head Chair Jerome Powell addresses his concern for high-risk areas in a new type of mortgage crisis. This was the buzz this last week on social, but not really addressed in depth, so I got you covered here. This and more covered here in this week's San Diego Market Matters, and I'm Karl Kyler, your San Diego Realtor. Happen to like my videos? If so, you can show some love by liking this video and subscribing to the channel. And if you're thinking of selling or buying here in San Diego, I have my contact info in the description below. Let's connect to see how we can make your next move happen for you. Now, let's get into this. A quick market check-in. Inflation is the hot topic, but I'll dive more into that shortly. Mortgage rates closed out this last week right below 7%. Not a significant amount below, but below nevertheless. The Fed's inflation metric, PCE, is sitting at 2.6% after its fourth month on the incline. We'll have an update on that at the end of the month. Be sure to cross your fingers and toes until then. As for unemployment, that's down to 4%, showing lots of strength in our job market. Now, let's jump into the hot topic mentioned earlier, inflation. The latest CPI and PPI data dropped this last week. Let's see what they tell us about the broader economic climates, how this might impact your wallet, and its influence on the housing market here in San Diego. Real quick, the CPI, aka Consumer Price Index, measures the change in average prices that affect us as consumers. It's what you and I feel on the daily basis. On the other hand, the Producer Price Index, or PPI, tracks the changes in average prices that affects domestic producers for their output. Essentially, PPI measures inflation at the wholesale level. The latest CPI report revealed, for the fifth report in a row, an increase in CPI, specifically a 3% increase over last year as of January. This rise is driven primarily by surges in specific categories like eggs, which saw prices jump over an unprecedented 53% year over year due to various factors including avian flu. All the more reason for me to be a proud vegan. Additionally, energy costs have also pushed the index higher. As for core CPI, which omits food and energy, it's pretty stagnant. So that's kind of good news in lieu of CPI going up the last 5 months. Now, switching gears to the Producer Price Index, PPI, the latest figures show a 0.4% rise on the month, slightly above expectations, but below its previous reading, so it's still coming down. We saw this decline in certain costs like healthcare and brokerage services, which suggests some easing in inflation pressures at the production level. Typically, when we see inflation drop on PPI, it should impact CPI at the same direction to follow. These inflation metrics are critical for real estate because they influence the Fed's decision on the Fed funds rate. The Fed's decision on that, even though it has nothing to do with mortgage interest rates directly, it affects the consumer's perception of what will happen to mortgage rates. I literally had a call with a buyer this last week who said he's waiting for the Feds to cut the Fed funds rate so he can get a better rate on his mortgage. This is how the public thinks. With CPI running up 5 months in a row and PPI suggesting still some ongoing inflation at the production level, mortgage rates were being slammed back and forth this last week. When CPI dropped, it was higher than expected, the markets freaked out, and mortgage rates bumped up. But then 24 hours later, we get some kind of good news that PPI still was up, but not up as much as the previous reading, so it actually brought mortgage rates down below 7%, 6.96%. Kind of like a Walmart 7%. For those of us in San Diego, this means preparing for a continued environment of high volatility in mortgage rates, which affects buying power and overall affordability of living here. I wouldn't be surprised if by next week, mortgage rates were back right above 7%. The key takeaway, while inflation may seem like another headline, its effects ripple through to mortgage rates, the housing market dynamics, and ultimately your personal financial decisions. Be mindful and cautious if you're looking to purchase a home. The cost of everything around you is still going up, so your breathing room between your mortgage payment and the money you have left over after it's paid each month may not be as much as you initially expected. So while on the topic of things becoming more and more costly, let's jump into the recent headlines about the inevitable impending mortgage desert. A mortgage desert, a topic that stirred quite a buzz on social media, but perhaps not with the depth it deserves. Federal Reserve Chairman Jerome Powell recently sparked discussions with a stark warning about a future of home ownership in certain high-risk areas of the United States, specifically targeting regions heavily impacted by climate change like parts of California and Florida. During a recent congressional hearing, Powell pointed out a growing crisis. Areas ravaged by severe weather events such as wildfires and storms are facing soaring insurance rates. This isn't about higher costs, it's about the very availability of insurance long-term, which banks require as a prerequisite for issuing mortgages. Without insurance, no mortgages. Without a mortgage, no homeownership. Simple as that, but with some complex implications. Jerome Powell paints somewhat of a dystopian future where within the next decade or two, entire regions could become mortgage desert as these environmental crises become more and more frequent and devastating. Imagine trying to buy a home only to find out that no bank will mortgage it because insurance companies have pulled out of that region completely. This scenario could become a reality in places like Miami, where insurance premiums are projected to jump a staggering 322% by 2055. Other areas like Jacksonville and Tampa aren't far behind. This rise driven by the undeniable impact of climate-related events, which, despite being a political hot potato, are real and affecting real lives and markets right now. So what does this have to do with San Diego? Well, here in San Diego, we're no strangers to the threats of wildfires. The question becomes, are we at risk of becoming a mortgage desert? While not on the immediate radar like some Florida cities, the increasing frequency and intensity of wildfires could put us on a similar trajectory. It's something you should keep in mind as a homeowner, buyer, or seller for long-term real estate plans. They claim this isn't a wait and see issue. It demands proactive planning and awareness. If you're a homeowner or a potential buyer in San Diego and similar areas, it's crucial to stay informed about these developments and consider them in your real estate decisions. Are you in a high-risk zone? Could future insurance availability and costs impact your ability to continue to own, buy, or sell? For local and state governments, the call to action is clear. They may need to step in where private insurance companies step out, ensuring these areas can still thrive economically. This could mean more robust local regulations and possibly state-funded insurance options to keep the housing market afloat, which, let's be honest, how in the world is California gonna do that? The idea of a mortgage desert is pretty extreme to say the least, especially if they are suggesting it could be the case in the next decade or two. Here's what I think is more reasonable to happen. Insurance premiums will go up as severity and costs go up. In turn, this will affect future affordability. Homeowners insurance is calculated into your debt-to-income ratio, which determines what you financially qualify for to purchase. Therefore, if insurance premiums surge, prices may come down. If insurance premiums go up that significantly, then it's very possible to see people on fixed incomes move out of San Diego, California, and other high-risk areas in lieu of finding a more affordable living arrangement. And that's a wrap for this week's San Diego Market Matters. If you stayed around this long, thank you. I'm so close to breaking into 200 subscribers. If you enjoyed this video, I'd love to be on your radar with other content. The easiest way to do so is with your subscription. Be sure to check out my other content that I've already posted. This video here is one I'm particularly excited about. It's how you can accelerate the growth of your down payment for your next home, as well as this one, which is a full breakdown of all the costs when buying a home here in San Diego. As always, I'm Karl Kyler, your San Diego Realtor. I'll see you in the next video.